Welcome to the Monopoly Mindset, the podcast where we uncover the strategies to build your real estate portfolio one property at a time.
We're your hosts, Tyler and Tommy, here to share our story of playing real-life Monopoly.
Whether you're just starting out or a seasoned investor, this is your go-to resource for mastering the real estate game.
So grab your board, roll the dice, and let's buy Boardwalk together. Welcome back to the Monopoly Mindset podcast, episode 37. Today we are going to be talking about this hypothetical new 50-year mortgage rate that Trump has come out and said that he's trying to get passed. So
Yeah, it'll be fun. I've seen a lot of memes. I think my favorite one was seeing Dave Ramsey looking like he just had a heart attack once he saw 50-year mortgages. But it's been cool to see the entire real estate community take this by storm and talk about it. So it's something Ty and I want to give our opinions and thoughts about.
yeah, and other than that, apparently the government just opened up today, like an hour ago, whatever that means, at least the day that we're recording this. So it'll be open by the time this podcast comes out. But yeah,
Hopefully.
it opened up. I don't really know what that means. I don't work for the government, so I wasn't really super affected by it. But it opened, and the stock market seemed to tank for some unknown reason. So I don't really know. That's why it's hard to pay attention to it because I don't know how everything like affects all this different stuff.
Yeah, that's just a fun slight at stocks. I mean, obviously, you should have both stocks and real estate in your portfolio, but it was a joke that Ty and I made this morning. It's like, well, at least with real estate, you typically don't say, well, what the F, or what's going on, or why did that drop, or what made that drop 6% that quickly. Typically, with real estate, a lot of things are in your control, and it does make sense, where at times stocks can go up and down. And I think stocks are best to look at from a long term view, right? Like over a year, 2 years, 3 years, not necessarily the day to day. But
Yeah, I mean, yeah, mutual funds anyway, or ETFs. I'm kind of against picking single stocks, but anyway, that's another topic. So 50-year mortgage, Trump announced that he wants to do it. Nothing's finalized yet. I don't think there's a lot of details out there, but honestly, me and you haven't even really discussed it too much. So I'm kind of curious to get your thoughts on it. So yeah, what do you think about it just overall as an investor? Will it help? Will it help homeowners? Will it help the housing shortage? Would you want to? Would you be interested in using it? Just give me your thoughts.
yeah, I kind of look at things and I want more answers. It's tough for me to make like a huge decision. I try to wait until I can make more of an educated decision. And I'm a lot of things I'm curious about. Like, is it even going to be open to investors? Is it only going to be like an FHA type of product for first time home buyers? There's a lot. And then you try to do, the amortization and see how much the loan is actually going to save you. And most of the time, it's only a couple $100, like $200 max, depending on what that loan is. And there's going to be differences too. Usually, interest rates are higher when you have like a longer term loan. And so, if you have a higher rate and it's 50 years, like it doesn't seem like there's that much savings. So, I think that there's some work to do on it. Like maybe they look at it as 50 years and they think it's safer for whatever reason. They give you a lower interest rate. That could make it more affordable. I mean, because the bank's still going to make double the amount on interest in general, adding the extra 20 years. So maybe they can go with a slightly lower rate. As far as like helping the housing crisis, I think anything that allows people to get into a house for a slightly cheaper dollar payment. I mean, everybody's money is spread thin. I don't think people necessarily care, hey, I'm going to pay $100,000 in interest or $1 million in interest versus $700,000 in interest. I don't think the average home buyer is necessarily looking at that. Um, so I think anything that helps people buy a house is a good thing. I that would be my 2 cents on it.
Yeah, yeah. I'm kind of thinking about all this based on what you're saying, and I kind of think that it would be to your point with the change in payment, so we did a few calculations, and like I just plugged in, I did $400,000 at a 7% interest rate, and at 30 years, your payment, I'm just principal and interest, your payment is 2661. At 50 years, it's only $2,400. So like, I don't really think people that are looking, and then you add in taxes and insurance, I don't really think that people that are looking to spend, let's say 3,500, they're going to be like, "Oh, it's only 3,300, so now I can afford it." Like, to me, it's not like a huge savings. It's $200 over almost a $3,000 loan, $2,500 loan. So it's like it's not even 10% less than, and then like I think a lot of homeowners, or at least a lot of people, you almost use their house as like a retirement plan, whether they know it or not. Like one of the things Dave Ramsey always talks about is like, I don't know, 90% of millionaires get there because they bought a house and then they just let it sit for 30 years. And like, let's say you buy that house at 30, it's 30 years later is like near retirement age. So it's like a good time. Like, okay, you can sell the house if you want and like downsize or whatever, but you have this like nest egg of equity that's built up. Well, now let's say you buy that house at 30, or honestly, I wonder what the average age is to buy a home in America.
I want to say it's like 40. I think I saw it was like 42 because they said you'll be 90 by the time that this loan goes into place.
Yeah, let me Google that real quick. But yeah, so like if you buy it, we're just gonna say 40, you're 90 by the time this loan is done. Personally, I don't think it's great for homeowners. I think just like everything else in our country, I think a lot of bad economic, we have the option to make a lot of bad economic decisions, like financing a burrito from Chipotle, right? Or like financing anything. And like, I'm agreeing with Dave here that it's like, this in my mind will allow people to buy things that they can't afford. Same with like financing furniture. And like, I also get the mentality of like, if it's 0% interest rate, my money's worth more to me now than later. So like, if there's all these things that are like, 0% financing for 3 years, and I've definitely fallen into that trap. But the longer you drag something out, it basically allows you to buy more because it's, less payment per month. And I think that's one of the downfalls of like America's, because then that's why we have all this credit card debt and like consumer debt, and it's like, I don't know what, like $20 trillion. And I know a house is different because it appreciates over time, but I think for the homeowner, one, it's not going to save them that much money per month. So I don't think it's just going to be like, oh, I can't afford a house. Oh, now I can afford all these houses. Like, I don't really see it changing that much. And then do prices just go up? Like, it's like every time we see like an interest rate drop, okay, people can afford $300 more. So now the house is $20,000 more. Well, then that $300 savings is gone. I don't know. But yeah. Now, for investors, me and you we're always like leverage at this point in our real estate because we're young and we feel like we can, grow. We want to grow faster by leveraging. I think I'd probably do it for investment properties just because I can maybe cash flow more. And when you're first starting out, cash flow seems to be like what most people want. So it would just be tough though. After 10 years, you're like, I basically still own like no more than when I started, other than, you're getting the appreciation of 10 years. But yeah, I don't know. There's a lot of scenarios and thoughts, but I think for the homeowner, I don't think it's the best idea. And I don't really think it's going to solve what they're trying to solve, which is more affordable housing.
Which is typical for America, right? We always try to solve things that we shouldn't, A, be trying to solve, and then B, we don't really solve it in the proper way in general. So I think that's kind of right on par. It makes me think that this will get approved by the time, the government stays open for another couple months.
Yeah, and then like from the bank's perspective, I know that they're going to be making so much money, but like imagine I know 30 years is a lot too, but like signing up that you will lend somebody money for 50 years, it just seems like it's more than half of somebody's life,
I think the other part that you and I talked about offline is most people only hold a mortgage for 5 years. So even though like we're saying 50, like even 30, I think that people that actually keep a mortgage for 30 years are very few. They're the millionaires of our country, which there's also very few of them as well. So I don't think a lot of people are going to keep this mortgage for 50 years. And then it's like, okay, well, is there a positive of getting into a house with a lower monthly payment that can appreciate and you at least gain a little bit of money from that perspective, from the property appreciating? Like, compare it to renting. I still think it's a better idea than renting, right? Because at least you're getting into a property that you can, semi afford with a slightly smaller payment. And I like, again, if you're only going to be there for 5 years potentially, and then you sell it or you refinance out of it, maybe you go down to a 30-year or something. Like maybe it makes it more affordable for that specific time gap.
Yeah, but see, banks make all their money when you refinance before every 5 years because you never actually chip into your principal. So like
Yeah.
at a 30-year mortgage, you have that graph. We could show a picture, but it's like your interest payment and your principal payment, and at a certain point they cross, and at first it's all interest, and then at a certain point they switch, and now you're paying more principal than interest. And I think for a 30-year, actually I have it pulled up, for a 50-year, it's around 12 years it looks like. Balance, I don't know. I don't think I'm looking at the right thing. But anyway, when you refinance after 5, 6, 7 years, even on a 30-year, you haven't really started to hit a lot of your principal yet. Like the principal comes in the back 15. So you're basically paying this bank all this interest. And then right as you're like kind of starting to get to the point where you're picking up on principal, you go refinance and restart and go back to, I mean, year one is the most amount of interest. So it would make it even worse if you did a 50-year because you're not really starting to see your principal go down until probably like year 15, right? Like
Yeah.
the first 10 years are basically going to be here. I can, on the example that I brought up, oh my, this is bad. So $400,000 loan, 50 years, 7%. And, people are going to be like, well, interest rates went down. So let me do 6.5. Okay, after 10 years, you paid off. Do you want to guess?
Well, I guess
$400,000 loan.
a percentage of it, or what year does it take into? I'm gonna guess
Dollar.
like,
How many dollars do you think you paid off in 10 years?
let's say 30,000.
15,000.
Damn, I thought I was going extremely low. That's crazy.
15. So
In
after
10 years?
10 years, you still owe 385. Now, look, if you look at the 30-year, after 10 years, you paid off 60,000, so you still owe 340. And here's where the difference between a 15-year and a 30-year. After 10 years of a 15-year, you owe 178, so you paid off like 220, more than half. But yeah, my point is you're not really getting principal pay down on a 50-year mortgage for
I'm
a
saying more or
long
less appreciation of
yeah.
the 3 to 5%. That's something that you would get. So even if you owed 390 on that property, 385. I mean, 10 years too. I'm talking only 5. But if the property appreciates 3 to 5% a year, there'll be something better than compared to renting where you're getting nothing. You're just throwing that 2 grand away. At least you're getting some sort of appreciation over the next couple of years.
I wonder though, like would that affect the like 100-year real estate has appreciated at 3% or whatever? Would that like somehow change property values in the future? Like would the average appreciation go down or would it go up because now people can afford more?
I
I
don't
would
think
kind
that
of
I
think it
don't
goes
think the
up.
affordability is really that much better. Like
Yeah.
I'm curious, like if you can't get approved for a mortgage for $300,000, like, and then we're like, oh, well, we'll give you a 50-year term, but it's only $200 a month cheaper. Like, are you really going to be able to afford that mortgage? You know what? Like,
Yeah,
I,
I totally agree.
I don't know how it really helps in that scenario. Like, the point that Ty and I were talking about offline that I think could make sense is if they gave you a lower interest rate, which there's no way the banks would necessarily do this. They, because there's more risk with a 50-year loan. But if it was a lower interest rate over 50 years, that could make it more palatable, right? But I don't think the bank would do that. Like they're still making more money on than a 30-year, but yeah.
Yeah, I don't see I don't see it being a lower interest rate. I see it being a higher interest rate. And the reason for that is to your point, the risk, because after 10 years, you've barely paid off any of your loans. So like what if there's some sort of crash or just like decline in 10 years, which there's probably a good chance that, it goes down a little bit at some point. You could be underwater pretty quickly. So like, at least with a 15-year, like your chances of becoming underwater are very little because after like 2-3 years you've paid off a lot. But yeah, I don't know. I don't think it's a good idea for honestly anybody but the banks because I think it's gonna be exactly what you said. A bunch of people are gonna get these 50-year mortgages. They're gonna pay 99% principal for 5-6 years, then they're gonna go refinance, start another one, and it's just gonna be a cycle where again, it's like the no interest financing thing. It seems like a good idea at the time for people, but then 10 years go by, they refinanced once or twice and kind of they've paid down no principal and it's just like we're really good at just like kicking the can down the road. I mean, like I don't know anything about what our country's debt means, but look at that. We're like what $50 trillion in debt and it goes up like a billions every day. I don't know. I think this is just another example of like allowing people to buy things that they necessarily can't afford, but they can afford the monthly payment. I don't know.
This turns home ownership into complete renting forever. If you
Yeah,
just
yeah,
because you're barely making any positive like principal payments, and then you're banking on the slight appreciation, and you're probably not somebody that should be buying a house if you're in that bad of a financial situation that you need that loan. It's to your point. It's a lot of like those people that get sucked into financing their burritos. Like this is a product that those people would think is great. And it's like you should not be financing your burrito.
but let me just say that it's a little contradictory because we always talk about one of the biggest benefits in real estate is getting the appreciation on the full amount when you only own a certain percentage of it. And this would actually make that benefit even greater. So, like, to your point, you're going to be paying, and this is why I would say I would do it for investment properties because the more money you can borrow now mathematically allows you to grow quicker. You add in risk into that, and that's not necessarily true if you multiply the risk to it because it is more risky the more money you borrow. But just kind of to flip on what I'm saying about it being the worst idea is like as an investor, if you can get a bunch of these and have more cash flow, you're still going to see that appreciation over 30 years, the same appreciation, even though you won't own the property outright, but borrowing money is allows you to grow quicker and
Yeah, and basically in this example of a $300,000 house, right, with closing costs and assuming you can put 5% down, it's roughly 20 grand, right, to buy that house out of pocket, like $15,000 down payment plus 5,000 in closing costs, or you want to do higher in closing
depends
costs?
what state. I mean,
All right.
my state's like
We'll,
15,000
we'll
in
do
closing
we'll do
costs.
10 in closing costs then because Ty is paying a lot in Maryland over there. So
I mean, like 20.
$25,000. What?
Like 20 is like probably pretty accurate in Maryland for like a $400,000 house.
So we'll do
15, 20.
25,000 down payment, 10 for closing costs, 15 for the principal, the 5% down on this 50-year loan. So you own it for 215 or 285 for this $300,000 house. But the point is, if you put the $25,000 into the stock market, you're getting 10% of 25,000, which is what, $250 a year?
2,500 on year
2,500
one.
in year one. And then what would that be monthly? Almost like $100 a month.
200.
Okay. And this is why Ty does all of our math. But if you were to get the $300,000 house that's appreciating at 5%, what does that look like?
Yeah, but 5's not. I don't know. I just like to use the long.
Sorry, say 3. Like 3's fine. I'm just trying
3.5.
play.
Yeah, 3 to 4.
But what would that be? 300,000. What it would be roughly 303 the following year, and then 306.
No, 309 the first year.
Okay.
We were. So yeah, you're getting 9,000 in appreciation on year one, and then another 9.2 or whatever on year two, and
So that's the point that Ty and I talk about leverage, is that you make the 1,200 or the 2,500 in year one if you invested the 25,000.
Yeah.
But if
I see what you're getting at.
If you put the same thought process into why it's beneficial to put the $25,000 into buying that property, you made $9,000 in appreciation in year one, which is, triple what you would have made on the 10%, because it's 10% of 25,000 versus 3% of 300,000. And that's the value
Right.
of leverage that we try to preach time and time again. Quick question for you, Ty. Do you know what mortgage stands for?
The word mortgage?
Yeah.
No.
It comes from Latin. So mortgage, mort means death, and gage means pledge. So mortgage means death pledge.
And the longer the mortgage, the more you're
So I feel like the 50-year mortgage is very fitting for this death pledge. You buy it at 42 in America, and then you're 92 by the time it's done, and hopefully you got a couple
these
days
banks
left.
are really selling us a product called the death pledge, and we're like, yes, give us more.
Exactly. But
Yeah.
I was going to say, let's take this from the top, because we did come up. I mean, that was Ty and I going off. We do have some positives for what we think the 50-year mortgage can come up with. So we'll just run through those.
Let me ask you this, because I know this is a positive. You have houses with 3% interest, right? If you could change those today to a 50-year mortgage, would you do it?
I think at 3%, it's not even a question. So
Exactly.
I don't know if
Yeah.
that's fair. Yeah.
Granted, I guess you can't get that anymore because you could only have gotten that like during COVID, but it depends what your rate. Yeah, because I would do it in a heartbeat if I could get a 3-4% mortgage, because you're locking that in for even longer. It's like almost, we say the banks are like preying on people, but if you have a really low rate, you're almost preying on the bank. Like, gotcha. You got locked in for 50 years at a super low interest rate. So, but can't get that rate anymore, so I guess that doesn't matter. Sorry, anyway, go ahead.
No, you're fine. I had a very terrible Harry Potter reference where you cheat death with the invisibility cloak, where the other two guys like died very soon because they didn't know how to use like the valuable tool that they just got. But the invisibility cloak guy kind of cheated death. So yeah, getting a 3% rate is almost like cheating death. So I thought that was fitting with the mortgage death.
Did you get that from ChatGPT?
No, I was off my own brain. Chat can't come up with something like that.
I don't know.
I watch too much Harry Potter. But to reline some more positives about a 50-year loan, you do get a slightly lower payment. Not sure how much lower it's going to be, but $200 a month is still $200 a month, especially for investors. To Ty's point, if that product was available for investors, a lot of us do like cash flow for whatever reason. Equity is really how we make a lot of our money, but we do like cash flow. So an extra couple $100, we're usually not going to, turn that down. And hopefully it opens up.
I,
Go ahead.
I feel like it's because it's like the number that in your mind is like financial freedom for most people, like is why new investors are attracted to cash flows, because you're like, okay, I spend $5,000 a month. If I can get $5,000 a month in cash flow, that's my financial freedom number. Whereas obviously equity builds wealth long term, but it's hard to like convert that equity into like your financial freedom number. You know what I mean?
It's hard to see that like process. I know what you mean. Like you can get to $300,000 in equity, but it's like, okay, how do I turn that $300,000 into a cash flow payment versus I'd rather just buy another house and build up more cash flow that way? Because like cash flow is what gets you financially free, not that you have $1 million in the bank.
Right. So 50-year mortgage would help you kind of get there a little quicker,
Yeah, if
theoretically.
they let investors do it, which there's a lot of unique loan products that come out that investors just aren't entitled to. And that's why we're all flocking to this DSCR loan right now because it's been one of the better loan products that's came out for investors. So there's a 50-year DSCR. We're going to have to bring Dom back on here and see what those rates look like.
Yeah, and even like 5 years ago when you first started getting into real estate and I was just getting started, you were telling me that like you could only get 20-year loans from your banks because you were going through like commercial banks, and then I got a DSCR and I was like, no, I got 30, but it seemed like even the 30-year was like somewhat of a newer product for strictly investment properties. So like I'm assuming that it would lag behind, and let's say the 50-year was just like a Fannie Mae, Freddie Mac backed loan, but then eventually, yeah, maybe these other companies get into it later for investors.
Yeah, and like you, that's the point of again why Ty and I do this podcast to spread our knowledge. And if somebody goes in and they're talking to a bank and they can only get a 20-year loan, like there are DSCR products out there where you can get a 30-year loan to try and get some better cash flow on your investment property. I think going back to some positives for a 50-year mortgage, it could increase buying power. I don't know if you're going to get $300,000 house, but maybe you can get 350. So maybe if you're at like the top of your budget and you can't get that dream home that you really want, it might allow you to get that dream home. Um, it's also an inflation hedge, which Ty and I kind of talked about a little bit. Maybe not from an inflation hedge perspective, but we talked about how you're going to get equity from the property appreciation, which is that part makes it more of an inflation hedge. Your payment's going to be fixed for half a century, so you don't have to worry about your payment going up. It's going to be set in stone. So as things get expensive and rise, you're going to have like this set payment for your entire life. And for investors, it's long term. It's kind of set it and forget it type of loan. So that's what Ty and I were talking about. We wouldn't necessarily mind it if it was a 3% rate. We would set it, forget it, and be very happy to only pay 3%. And then,
So let me just throw out a stat
yeah,
that's kind of against it, is the median age for home buyers in the US is 40. I think that's what you said, right?
yeah,
So what is the average lifespan?
got to be 75.
I'm going 72. Okay, 78 in the US. Of course, it's shorter for men, but so they're selling a product that on average you're going to buy at 40 and you're going to die at 78 and still have 12 years left on your payment. Like it seems like
And
a
it's
student
mainly going
loan.
to be all principal at that point. So you're only going to have paid like the $2 million in interest
So
over the
you're
time.
missing the best 12 years, right? Where you're actually paying a majority
I
principal.
think the
I don't know.
argument though is like, what if it gets more and like how does it compete with the FHA type loan products or like 5% down type loan products that are really good for first time home buyers? Like, does it compete in that avenue where it like because an FHA loan is going to have like extra requirements and whatnot? Like, could this potentially not, and like saving the $200 a month, does that help somebody that's 22 buy a house and now they're living to 72 so they get to pay it off before they die? Um,
Yeah, and yeah, I don't know, but we'll see.
I
We'll see. I mean, obviously, I think politicians say a lot, right? And then these things don't actually happen. But
just love the traction that's came with it. And again, the Dave Ramsey meme was my favorite one of him having a heart attack once he saw this. That was pretty crazy. But like to your point, let's jump into some negatives because I think predominantly we've been negative about this, but one of the worst things is you pay way more interest. Like the total interest can be double. And the lifetime cost, if you keep that loan for 50 years, is going to be very expensive.
if you live long enough,
Yeah.
yeah, I mean, yeah, we've been kind of being negative about it, but again, I think I'm being negative in terms of the entire country. Is it a plus or minus for the entire country? I'm saying no. I'm saying it's bad, but I would use it for investing. So I like it personally, but I don't think that it solves the problem that it's saying it's trying to solve.
100% agree with that. It might help 5% of the country. It might be a good product for them, but overall, it's not going to be a good product for a lot of people. Investors, if it's able to be used by us and rates fall a little bit, and you can get like a 5% and set it and forget it for 50 years versus doing like cash out refinances every so often, maybe. But even then, like over maybe like 5 years ago when I started, I would have liked it more. Right now, I don't know if it's a product I would use.
Yeah, right. Because again, I'm already kind of like wanting to pay off loans like a little
Yeah.
quicker. So like I'm kind of going the other way of looking at 15 or 20-year loans just because I think it would be sweet to actually have like a paid off house.
Yeah, and I
Which
have a couple 20-year loans, and the way that like the principal payment is like half, which is awesome. But I'm paying $2,000 and 1,000's going to interest and 1,000 goes to principal. Like that's very good compared to
yeah,
most people. It's 1,700 to interest and 300 to principal. So if I save nothing an entire year, I'm paying off $1,000 of principal plus I'm getting appreciation on my property. So I'm in a really good spot with that loan. As much as like I've hated it because I didn't get as much equity. I think I did like 70% loan to value, and like I wish I would have gotten the extra 5% at the time. But now I'm like, it's been 5 years that I've had this loan, so I only have 15 years left on it, and I'm paying a significant amount.
right. But when you first start, you're like, give me a 200-year mortgage. I'll take it.
Yeah, yeah, exactly. Um, More negatives about the 50-year loan, slower equity build. So Ty already talked about that, but the first 10 to 15 years, you're barely going to touch any principal, which is not a very good solution for people. Kind of become riskier for becoming house poor, which again, Ty and I touched on. But if you don't qualify for that much more and you're like, oh, let me get this 50-year loan to qualify, it's very similar to just getting a car note that you should not have been approved for. Somebody has $1,000 a month car payment because they are paying a 15% interest rate, but they were able to get approved. It's most likely going to get repoed in a couple years. Like it doesn't really fix the affordability, it kind of inflates it.
Yeah, and I feel like if you're I mean, I've felt this way for a while. I feel like if you're right on the line of being approved or not for a house, you probably shouldn't be buying a house because they are not factoring in. I think they over approve people. And maybe people don't want to hear that because there is apparently a I don't know, housing shortage or housing's too expensive, but I feel like they don't factor in when they're looking at like debt to income. They don't factor in are you saving for retirement? And so like let's say take 10% of this away and like are you saving for this and this and this? And I feel like personally I think like if you're not saving at all for retirement, you probably shouldn't be buying a house. Maybe that sounds Dave Ramsey-esque, but like I just feel like they over approve you. They look at just gross income and like my paycheck is significantly less than just my gross monthly income because I'm setting aside money for things, and that's not part of their calculation. So is
I
it gonna
think
go? This could potentially take somebody that's like at a 55 debt to income and put them at like 49, and now they're approved. But I still don't think they should be buying a house at 49.
just to play the opposite side here, as much as I agree with you, unfortunately, most of America doesn't invest for retirement, right? I think that's a pretty like known fact that most of them don't. And then they're also not necessarily buying a house either. I'd argue if you could do one thing, it's and just because like you have to pay to live, like unless if you're living somewhere for free, if you have to pay somewhere to live, I like the idea of at least being able to get into a house and having some sort of equity being built, even if it's maybe the 50-year mortgage, not necessarily, but a 30-year mortgage. At least you're building some sort of equity over time if you can get into a property. Because, like, I hate that if you're renting, you're just throwing away $2,000 a month and then all of your other bills are coming up and, like, you can't afford to invest or do anything else. At least if you own the house and you're paying $2,000 a month, you're getting some sort of principal built up in that
Yeah,
property.
20. You're at least getting $20 the first couple
Yeah,
years.
yeah, but then you're also getting appreciation. Like I just find that
Yeah.
like, and then you talk about like if you could do nothing else, but you bought that house, you owned it for 30 years, you probably have $500,000 of equity sitting there that can be passed down to your children and whatnot. So,
Yeah, I
or at
guess
least,
I'm being harsh on it. I think we both would still say it's a lot better than renting, right?
I mean, I think we kind of pivoted there a little bit to just saying like people need to invest for their retirement in general. And like, we wish that more people met with financial advisors and realized how important it is to invest at a young age. And you can see how much your money grows from 20 to
Or
70 versus 30 to 70. Like, it grows significantly more.
or
Um,
just go on YouTube or like listen to a
yeah.
podcast. Like I've never met with a financial advisor. Yeah, just run some numbers and you'll see how important compound interest is.
I'm with you, but those people that aren't doing anything from a compound, like I find that buying a house is like the easiest way to invest versus
Right.
just paying rent and then you're never going to invest anyway. At least if you bought a house, you're going to get some sort of return if you stay there for a long period of time. It gives you something. And or at least it gets somebody thinking, "Hey, I have a house, I have this payment." It becomes more, I almost want to say like it makes you become more of an adult in some aspects. Like if you're renting, like you might not have a care or responsibility, but if you own the house, I think it starts giving you more responsibility and you're like, okay, like, oh, I could pay this off one day and like what does that look like? I think it just kind of flips your mindset a little bit once you become a homeowner. And maybe I'm wrong on that, but it's a opinion that I have.
Yeah, well, after buying this house, I've considered just renting for the rest of my life, but continuing to buy real estate and invest in real estate. But just like if my dishwasher breaks, I can call somebody.
I think you're
Sounds
gonna
kind of
buy
nice, to be
a brand
honest.
new build with a warranty in Wilmington here in the next couple years.
Yeah, yeah, I'm definitely yeah, definitely want to buy something newer than like
So what?
20. Yeah, but
One last, go ahead.
yeah, go ahead.
One last thing that I don't know, I'm trying to make this work and I don't know if it works, but I listen to Mortgage Mondays with David Green every so often, and they had a decent episode last week, and they talked about they had a loan officer on, and he mentioned if you go with a 30-year mortgage versus like a 15 or a 20-year mortgage, it gives you like a safety net of what you have to pay. So say if it, like you talked about earlier being like a $600 difference maybe from a 20-year to a 30-year, right? Because you're paying the principal down, or I think you said 15 to 30 is almost
Oh, it was
a
like a
thousand
thousand.
dollars,
Yeah, it was
thousand
like a
dollar
thousand
difference.
dollar difference.
So one of the perks about a mortgage in general, like if you can just get approved and let's say your payment's $1,500 is your baseline on a 30-year mortgage, or let's use 50-year mortgage in this example. If you have a 50-year mortgage and you're paying $1,500 a month, like that can be your baseline of what you have to pay. But say if you have a good month and you want to throw a little bit of extra, or like you make one extra payment a year, that 50-year mortgage is now going to be paid off in 38 years just by paying another 1,500 bucks a month. And so there's opportunities to just get approved for a loan, but then not like those loans, like that's like the bare minimum payment. If you ever make extra principal payments, you can turn a 30-year loan into something very lucrative. And you can do the same with the 50-year. And that's just one,
Yeah.
like, again, it probably doesn't work for the 5% of people who are saying this barely gets them to afford a home. They probably don't have the extra money to do that. But even throwing an extra 25 or $50 a month towards that significantly like drops that loan.
Yeah, I that's actually a really good point that I didn't really think about is yeah, I don't think the math is the same. Like if you were to pay it off in 15 years, let's just say you did that 15-year payment even though you had a 40-year mortgage. I don't know if the math comes out exactly the same, but I like that idea is like get the 50-year, you can easily pay it off in 30. But if you lose your job or whatever, the housing market goes down, whatever happens, your minimum required payment is a lot $200 less, right? Not a lot less, but it is less than if you went and got a 15, 20, 30-year mortgage. I do think I think it's hard to do that though. It's like again, this is a Dave Ramsey kind of mindset is like you spend less on debit than you spend on credit. It's just like a mental thing. I think it's hard for people to be like, my mortgage is 1,200, but I'm going to pay 1,500 every single month for 30 years. Like it's a hard thing to do because then it's real easy to just be like, oh, I could take that $300 instead and buy something nice. So it's like
Yeah, it's easy
mathematically
to
what you're saying is actually a really good point, and it makes a lot of sense. But are
it's
people
easier
actually
to
going to do that?
it's easier to set it and forget it. I think on my first property that was an FHA loan, my mortgage was, let's say, 1170. I think I paid 1250, so I was paying like $80 extra per month to try and go to principal, which helped, I think, get my loan paid down a little bit quicker. And then I ultimately refinanced and I stopped doing it. But there, the Mortgage Monday podcast, they talked about in certain aspects of real estate where it's tough to make deals work right now. A strategy that was relatively cool was putting extra money towards principal because you're getting X percentage back by doing that. So I thought that was a cool tidbit that I thought about. I don't think I'm necessarily going to do it this year, but it is something to think about.
Yeah. All right. Well, we will come out with an update to this episode once we find out more information. I don't know how long it's going to take. I'm assuming a long time, just like everything else in the government. But yeah, whether they move forward with it or if it just gets squashed, who really knows at this point? But like you said, we'll hopefully have more details. What are interest rates going to look like? Is it for investors? Questions like that. So we'll do a follow up when we get the information.
Yeah. So thank you for tuning into episode 37, and we will see you next week.
See you later.